Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome to another episode of Markets, Mystics and Mayhem. I believe we're up to episode 35. We're going to turn up the heat this week. We're going to have a bit of fun talking about forecasting. We've updated our forecast for the beautiful Kiwi economy, and things are a little mixed, to put it politely. Lots of risks offshore, risks onshore, and how all that plays out is really important for our thinking. So I'm going to kick it off. We're not mucking around here. How do we forecast?
Yeah, it's always a very involved process. Well, first of all, we start off with the international scene. It's a very important sector, the external sector. I think international trade is like 60% of our GDP. So it's pretty significant. We are a small open economy, obviously. We have a limited influence on our trading partners, but their performance has a very big influence on our economic cycles. And when we were looking, going back to the drawing board this time around, the international scene didn't look too good. President Trump's tariff agenda is really throwing up a lot of uncertainty about global trade and the disruption. You've got the likes of the IMF and the OECD all slashing their forecasts just as we're starting to grow domestically. So that's kind of the background. The trading partner growth this year doesn't look too good. So we consider that along with other factors, and we try to estimate something called the output gap, which is basically the difference between, New Zealand's actual output currently between that and potential output. And potential output, taking you back to Form 6 economics. It's basically the level of output of activity that the New Zealand economy can sustainably produce with all its resources available to it without generating extra inflation. And right now, when we're looking at the output gap, it's negative. And that's our starting point, a negative output gap. And what that means is, there should be reduced inflationary pressure from there. So we're expecting domestic inflation to continue cooling from where it is now. Also, negative output gap means that you have a soft labour market. So we're still expecting the unemployment rate to stay elevated, potentially peaking a little bit higher than where it is now at 5.3% this year before things start to turn. So we do think that output gap turns positive over the forecast horizon, but because our starting point is negative, we are still growing basically below potential. That's the basic summary of it, but we can totally unpack all of that stuff.
Well, that's a very good summary. So basically, if you think of it like a car, if we're driving at 30 k's an hour, we're allowed to do 50. Mm-hmm. We're just not at that potential, are we? We're running below, which means there's a lot of slack in the economy, and that means that there's disinflation pressure coming through. You didn't answer my question.
Why?
I asked how.
I'm not going to go into not into the econometrics.
Well, hell yeah.
Maybe you could do a short answer if we look into a crystal ball.
Yeah.
Well, that's true.
That's where we start. Okay.
You look at like the IMF forecasts and you go, well, that they've downgraded those.
Yeah.
So that goes into the equation.
Yeah.
And then what are some of the things you look at?
Other things that go into that output gap are things like housing markets or house prices, how they've been performing. We bring in the external sector through things like the TWI, the trade-weighted index, that kind of gives us how the exchange rate is helping us or hurting us. And also real interest rates, how they've been, over time, they've been in decline, right? But then that trying to gauge how that impacts the output gap. All those things, we put it into a model, we do a regression, blah, blah, blah. All of that e-views, if you're into that kind of stuff, is how we use, how we make our modelling, do our modelling. So, and all of it
believe you
spits
just
it
said
out.
Blah, blah, blah for our entire job.
I know 3 words to summarize our whole career. But no, I mean, we all think it's really fun, but to make it, our job is to make it simple.
Yeah.
And we put it all into this black box. It spits out a number that tells us the economy is weak, as you're saying, growing below its potential. But our job is also to forecast, so how we see things going from here into, the next 3 years. And from there, we're expecting growth to rebound, not as strongly as what we thought the last time we were doing our forecasting, mostly because of what's happening overseas.
I love how some commentators say forecasting is a waste of time. Actually, no, it's a very important function of what economists should do, and it has a direct impact on our clients and the bank. I mean, the bank's asking us for like an unemployment rate forecast, because off that you get an idea as to how many defaults there are likely to be over the forecast horizon. We go through scenarios, just in terms of why we forecast.
Yeah, I mean, as much as we want it to be about getting that exact point right, we've got GDP and all those quarterly forecasts, as much as we want that exact print to be exactly how we expect it to be, the point is really about providing a roadmap of how we can get businesses and policymakers thinking about the future and having to plan and future-proof their businesses. Because, I mean, this is a classic example of how forecasting can be quite impactful because it's just so uncertain. You just don't know how it's going to play. We do scenario analysis to kind of deal with that uncertainty, but it really is just about that roadmap of where will things go from here.
Okay, you said scenario analysis. What's that?
It's basically looking into many different futures that the economy can take. There's no one single path that can happen. And when things are, as uncertain as they are now, you have just different assumptions of how the economy can, unfold from here. Yep. And so we did 2 scenarios this time, one upside, one downside.
And to our clients out there, we can give you a rough path as to where we think things are going, but the important bit is the scenario analysis. It's how will your business handle upside surprises, which might mean the currency is going up, interest rates may have bottomed. How does your business thrive or struggle? And then there's downside scenarios, and we're saying that the downside risks outweigh the upside risks. So how does your business perform in that world, also with the currency declining and interest rates declining by more? So it's a useful kind of process. I think it's a very useful process to go through.
It's just to help them kind of hedge their exposure or reduce their exposure should that scenario or that future play out. And as you're saying correctly, that the balance of risks this time around are very much skewed to the downside.
Do you pick lotto numbers?
No, I keep this gambling strictly for professional work.
Not when there's money on the line, right?
Yeah, exactly.
That's why you're not a trader, right? You
Honestly, that job is just too, that you have to have quite a, you have to have the stomach to put down money for that.
Yeah, traders do a great job. They often take views on whether the interest rates are going up or down, which helps hedge the bank's risks, obviously. That's what our treasury does. And then we've got people doing the same in currency, right?
Yeah. Or do it for a coffee,
Oh, absolutely. But putting millions of dollars on the line needs a certain personality. I'm definitely not one of those.
Yeah, your
people.
brain has to be thinking about that 24/7.
Yeah.
So a lot of people are doing scenarios right now, not just us. The Reserve Bank did some for the first time in 5 years. Treasury's been doing some. And our scenarios are a little bit different to the Reserve Bank's, right? So they had an upside that was based around whether tariffs are more of a supply side shock and their downside is more of a demand shock. But our scenarios, it is a demand shock on the downside. But our upside's a little bit different, right? Because we're sort of assuming that in whatever world we go to from here, tariffs are some part of that world. So talk us through a little bit more about how do we pick our upside and our downside and what the differences are there?
Yeah, I mean, this is where we can get kind of creative because, as I said, there's no way to know how the future will play out, and you just make different assumptions based on a future that you create. And this time around, I think it seemed appropriate to assume that tariffs would be a feature of the future in any scenario. Our upside assumes that there is, at least for the next 3 years, we have that disruption. So we still take IMF's forecast into account there. But the one assumption we changed is, what if the New Zealand economy domestically, things get much better than what's currently happening? What if the housing market picks up a lot faster, a lot stronger than we expect is to happen in our central scenario? What if that's because migration suddenly turns a bit more positive and we don't get many departures of New Zealanders, for example? So what if the economy picks up much faster? In that scenario, we see we may be near the end of the cash rate cycle. We could see hikes starting to be priced in earlier than what's currently being priced in, just naturally as the economy grows and you get a bit more inflation into the projections. That's the next step for traders to be thinking about. But that's our upside scenario.
Yeah. And the downside, which we've said the risks are tilted towards, what's that?
That one, again, is so up to your imagination, really, how much downside you can do. But this one is more about, the global economy just deteriorating faster and much deeper than we assume in our central scenario. It could be going back to those Liberation Day tariff settings. It could be, this escalation in the Middle East that's already kind of playing out. What if that, escalates and stays, quite elevated in terms of trade tensions, and it, spills over to the energy sector and all of that? What if that kind of is or any other black swan event, really? What if that's what eventuates? We obviously see the economy deteriorating a lot more because of the global economy, and it requires much more easing from the Reserve Bank, much more stimulatory policy from the Reserve Bank.
Because, the US and other consumers could be hit quite hard, right? You could be hit with a tariff, which is a tax, and that obviously influences consumers and businesses. And if the escalation in the Middle East continues and oil goes to $100 or more, that's another tax on consumers, right? The oil price, petrol price going up acts like a tax. So consumers could be hit quite hard in this world.
Yeah, and you're kind of seeing that because just after the Middle East conflict escalating last week, oil prices, they surged like 15% on Friday. Maybe it unwound a little bit. But what was really interesting is how it's starting to target the energy sector, which I'm no history expert or anything on this conflict, but that seemed like an unprecedented move to be targeting that, which has very deep impacts for the global economy if you're, targeting energy and oil and all of that.
Yeah. Well, it's fascinating. I think fascinating time right now. These tariffs coming on. What does that mean? This sort of conflict also in the background. What does that mean? I think you're right. Like the downside risks to me dominate our thinking, and bringing that back home. What does it mean for our export sector? What does it mean for our economy? Because we had field days last week. So,
Yeah, I think what we'll hear more and more is this kind of two-speed or two-tier economy developing. Field days, I've been getting the emails from it. It seemed like quite a successful event this year around, which is what we wanted to see because we've had really strong export prices. So hopefully, farmers had more money to spend. They have big toys on displays. Hopefully they were in a spending mood. But, primary industries are doing really well. I mean, Sabrina, you did the GDP forecast for the start of the year, and it looked pretty strong for primaries, right?
Yeah, the primary sector has definitely been one of sort of the more stellar performers. But as you say, it's very two-way speed and it's kind of a divide. You still have your more interest-sensitive areas like construction. I think actually this morning I was reading a Reserve Bank analytical note. Wasn't anything too new, but they were just rehashing that some areas are more interest rate sensitive. The sort of external sector isn't, but then you've got things like construction, manufacturing, that's all still really sensitive and not performing very well. Manufacturing did have a bit of a successful quarter, I'd say, this first one, but it's looking like it's going to, deteriorate over the second quarter. But
PMIs, right?
Yes.
Gave you an idea there.
PMIs, which we talked about in the last episode. We were talking about US PMIs. Now we're seeing which contracted. Now we're seeing New Zealand PMIs also heading back into contraction. So it is a very like two-speed economy, as you say, which is just a bit sad because I think also something that's really annoyed me about writing this outlook is that, you know, we started off, it seemed like at the end of last year we were really ready for this recovery. Like if we hadn't had this tariff situation, a lot of our forecasts would have played out, you know. Globally, central bank inflation was being contained. The war was won. Central banks were cutting. We were starting to see this positive indicator data domestically. Again, it was kind of limited to the external sector, your agri, a bit of tourism, but it seemed like there was some really good roots kind of being planted and sprouts coming from that. And it's just not quite there yet. And we are getting that two-speed direction going now.
I think that is our biggest concern, right? It's that the sectors that have led the recovery out of last year's recession are the most vulnerable to what's happening overseas.
Exactly.
So that it's a very fragile, very tentative recovery that's at risk of, you know, a slowdown, which is kind of what some of the indicators for the current quarter we're in, the June quarter, are showing that we could see a slowdown in growth. So it's not going to be that sustained 0.7 every quarter, it seems.
Yeah, and I think that goes back to our call, particularly our call on interest rates. So you've got this massive uncertainty offshore, potentially hitting our strongest sector, which is the external sector, agri, all of that. That worries me. And within that sector, they are upbeat. It does sound like they're in a bit of a spending mood, having gone to the field days last week. You know, that investment boost, great, all that sort of talk. But then you outside that group, particularly construction, like you say, very weak, very soft. The feedback we're getting from them is, you know, we're not in a recovery yet. We're still waiting. So this two-speed economy that you talk about, to me, it's the interest rate sensitive ones that are underperforming. So clearly interest rates are still too high, right? We are not in stimulatory territory when it comes to interest rates. So I still don't get why the central bank's kind of hinting that they may pause in July or what. I don't care. You're at 3.25. You need to be at 2.5. Get there.
Yeah, get there, and then you can wait around once you're firmly in that. I know they said we're in a neutral zone, but I think there needs to be a bit more easing to see those interest rates fall. There is a lot of mortgage rollover to June the next sort of 6 to 8 months, and they'll be going to much lower rates. So there is a bit more of the pass-through to come through, but I think we still need that cash rate inside that stimulatory territory to, you know. Yeah,
otherwise we'd be seeing, you know, we'd be hearing more from the interest rate side, and we'd be hearing more out of construction and housing, and that we're just not at the moment.
Yeah. It's already a delayed recovery, right? And it just risk delaying that further, and also risks further softness in the labour market that doesn't need to be. And then it goes all the way down to inflation, and you risk inflation falling below that 2% target, which we already have kind of being penciled in.
Yeah. So what does that mean for rates and then FX and then businesses and households?
Well, it depends on how much the Reserve Bank actually does deliver in terms of easing for rates, because markets have been pricing in at least another 2 rate cuts. If they go to 2.5%, you'll see you'll see further falls in retail rates. Maybe that 2-year gets closer to 4.50, which would be welcome news for many businesses and households. But in terms of FX, honestly, don't know, because of we were talking about our forecast and we said, you know, end of the year it will trade at 60, be at 55 the first half of the year. But we've seen that entire year forecast in the span of 6 months.
Yeah.
So it's so difficult to pick currency. Lots of volatility, you know, during the week. But yeah, I mean, I guess our more macro view is that it does, strengthen over the course of the year as the economy rebounds.
Yeah. Anything else on currency?
No, I think it'll just be nice to get back to when we can just look at interest rate differentials for currency.
Yeah.
Because right now it's not really interest rate differential driven. It's just the volatility, the news, the headlines, the risk on, the risk off. So it's not fun right now because we love interest rate differentials. That's what we go by, and we can't just rely on them at the moment. But that's my 2
and
cents.
there's that question being asked around the dollar, and is it a safe haven, and does it deserve to be the reserve currency? So there is a bit of dollar weakness there, which is not helping.
Yeah.
Would be nice to have the Kiwi dollar a little weaker, just to provide a little bit more support into that external sector. But they're doing well, and I do think the currency will ultimately react if there's downside risk. It will fall eventually, but right now I think we're in a bit of a trading pattern, which is not fun for households, but it's good for, I think, exporters and importers, just knowing that the currency is not going to be 5-10 cents higher or lower. Just knowing around that 60 level, I don't think that hurts either side of that equation.
Yeah. But if you were to list out everything that's happening currently, you wouldn't think that the Kiwi would have hit a year high a couple of weeks ago.
You'd be low 50s.
Yeah.
Based on headline risk alone, interest rate differentials that you talk about. I mean, that's where we forecast it, right? In the mid 50s, and things have turned out worse than we thought. So. Yeah. Bringing that back to mum and dad and businesses, what do you think the outlook tells them?
I think it's one that we're still expecting a recovery. It's just slower because of what's happening overseas. It just highlights how much we depend on the international economy being in, performing well, that we should see the economy performing well, but that's not the scenario right now. We still expect growth this year, just slower than what we saw before. And hopefully that means, we see more easing from the Reserve Bank. Yeah.
Yep. And businesses, depending on where you are, just, fight your way through. We are optimistic that growth picks up slowly this year and then accelerates into 2026.
Yeah.
So for businesses who are in a reasonable state, maybe it is time to have a look around at investments and opportunities. I think this is the environment where, it is a good time to look at opportunities.
Yeah. Knock on wood. It seems like the the worst is behind us. We had a very deep recession last year. We're crawling our way out of it. We're still expecting growth, and when you've got that as your outlook, it is a time of maybe this is a time to start expanding in terms of investment, in terms of hiring. We are still expecting that thing.
I had a construction guy, a developer. In residential construction, that is, say to me the other day, now's the perfect time to build. He said the cost of materials have stabilised and gone down in some areas, and he said, I could give you a timeline to build your house, which sounds pretty obvious, but in New Zealand you haven't been able to get one of those for many years. And he said, I've got my choice in subbies, tradies, right? I can get access to plumbers, electricians, whatever you need. We could build your house right now. So basically there's a lot of capacity there.
Yeah.
I think something everyone listening might want to know is, when's the housing market getting better?
Right, we're just on it.
Yeah, that's the thing. That the housing market makes a fool out of any forecaster. And it just has not performed as strongly as we expected. The Reserve Bank has cut interest rates 225 basis points. The housing market has been trading sideways for a really long time. It's the lack of investor activity. I think we're starting to see some signs that they're returning to market, but without that, we have seen house prices pretty much trade sideways. They're starting to show a bit of a lift. I think it's been 4 straight months of small increases. So we are hopeful for a lift in house prices this year, maybe around 2 to 3%, a bit softer than what we thought initially. But then next year should be when we see investors come back in, and we hopefully get to that 5 to 7% house price gain on an annual basis.
Yeah, I think just to frame that for people, like we have been the most conservative in our forecasts. On the lower end of consensus, calling for more rate cuts, obviously, but we've been surprised on the downside.
Yeah.
Right? So you're not talking to forecasters who, you know, we're thinking about, you know, rainbows and whatever. No, we've actually been quite conservative the whole way.
Yeah.
And we've been surprised again on the downside. And it just hammers that point that if we're being surprised on the downside, then, you know, clearly things have not performed.
Yeah.
And again, we need more response. We can't get it from the government. Their hands are tied, very difficult budget to deliver. So we've got to get it from monetary policy.
Yeah. No, that's really good context.
Okay, one more market to go through, a bit of a different one, the labour market. I think you mentioned it a little bit already at the start, but I think the labour market's also a good one to go through, maybe like the upside or mainly the downside. It's quite an interesting path that the labour market could take if we did see things play out worse. So what's actually happening in our central scenario, and then also how does that compare to potentially the downside?
Yeah, our central scenario still assumes that we're kind of near the peak of the unemployment rate, which is, as you expect, the economy starting to turn. So we should be near the end of that softness in the labour market. So we still expect it to climb a little bit higher, 5.3%, which is not as high as we saw in previous recessions. But still, 5.3% is our peak in the unemployment rate. Before we start to see employment growth start to rebound at the end of this year, going into 2026, as the economy picks up and we see a bit more activity there. So firms will start to hire again. But it's mostly a 2026 story for that rebound. In terms of the downside scenario, when you've got a much weaker economy, you could see the unemployment rate climbing to about 7-8% because of just the uncertainty and the slowdown in the global economy. That'll have, you know, rippling effects for the housing market and all of that. So, but yeah, that's kind of our forecast.
So we don't like 7-8%.
As a bank?
No, we don't. We don't like that at all because the relationship between unemployment and defaults and other bad things happening is kind of exponential. So we do see a lift in defaults, and we have as it's gone from 3.2, excuse me, to 5.1. We've seen a lift, but it gets more exponential as it goes up to 7-8.
Yeah.
And that's when banks go, oh, you know, we might start seeing a whole lot more defaults.
Yeah.
And it sort of snowballs a little bit from there. So this is the scenario analysis stuff, right? Our central scenario, what is it, 5.3? That doesn't alarm us too much. 7 to 8, that does.
Yeah. Yeah, we're involved with those stress test scenarios for the bank, and they can get pretty ugly, those numbers. And
tell us about a stress test, because stress tests are
That's
cool.
when you break the bank, right?
That's the goal. That is a brief. Try break the bank.
Can we reframe that and make sure people understand? What do you mean you're breaking the bank?
You're just trying to find a way that will really push the limits for the bank. And you have a scenario where it's a very prolonged, deep contraction in economic activity that flows through to the unemployment rate reaching those highs that are pretty scary for the bank. And then house prices go down to, you know, double-digit declines.
Yeah.
And then you start to see, you know, defaults rise, or how will the bank cope. That's when you get really creative about your assumptions and what goes into that.
That's the cool stuff, right? As an economist, that's kind of fun. But from an outsider looking in, it's like this is how we manage financial stability in the economy, right? We do stress test banks. We want them stressed as hard as we can to know that should something really crazy like one in a 200-year event or something happen, that these banks don't fold like they did in the United States in the 2008 crisis.
Yeah, no, it's a really good kind of exercise to go through.
Yeah, and it's cool for learning, right? You learn, oh wow, this happens, that happens, and that feeds through, and you get a really good understanding of the economy going through the stress tests.
Yeah.
So to sum it all up, I think the main takeaway is that we're still expecting a recovery. We're through the worst, right? But it is just a slower recovery from here, which means, you know, the labour market's still deteriorating for a bit longer. House prices still a bit sluggish for a bit longer. But inflation, it's contained. We're happy with that. And really, I think the other key message here is that actually we just need a bit more interest rate relief. That's really what's kind of stopping things right now. And not even just stopping it, but just given all the risks, it's what the economy needs right now. So I think, it's still positive news that we're moving forward. We're leaving the past 2 dark years of recession behind.
Yeah.
And we are growing, but we really want to see greater growth in the future. So I think, please, interest rate relief. But that's all from today. I think if you like this episode, we did publish a really great what we call Outlook note, which just has MJ's forecast all put together with some really fancy charts, some which will already have popped up during this episode, but it's a really great piece of work, one of our big pieces for the year. So do check that out. We can include a link in the podcast. But otherwise, make sure to follow, like, and subscribe, and we'll see you next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.